Morning all, how are we all doing? Everybody good? Just move the mic away a little bit. Morning Andy, morning Diamond, morning Ladder, Peter. Morning, afternoon. Was busy yesterday, didn't do any trading. Woof. Blimey, how'd you do that? I'd imagine not trading. Morning Jane, morning Rocky. Yes, as you can see, I had a busy day yesterday. Lost 1.2%. Got it back this morning, but yeah, tricky day yesterday. Stupid Euro New Zealand and stupid spreads keep taking me out. So yeah, not amazing day yesterday, but you have them every now and again. Morning, Jeff. So just do a quick recap of yesterday to kick off. Passed that evaluation yesterday. That was good fun on the EA. So yeah, just took that one trade in the morning and passed it with one trade, 8% profit. That was my plan, was just literally go long or short on the index. And I was planning to do it in the afternoon because I was expecting the news, but I took the trade in the morning and it collapsed, which was lovely. Yeah, stage 2 today. Probably blow it today, usually do. I only took one trade yesterday as well. It was nothing checking me. Cool. So yeah, yesterday basically what did I do? What was the date yesterday? 14th. So started off with that Euro New Zealand loss, which was an aggressive position. Had another one yesterday there as well. So had 2 aggressive drawdown control attempts yesterday on that drop and on that drop. Both failed. Took a third one, which I closed out this morning, which worked. There was 2 more actually, yeah. Look. Yeah, 4 yesterday. 1, 2, 3, and 4. That was a tiny little one, that one. But look where I got stopped out. On that position and that position. Then look what's that. Them's the breaks when you're using stops. So yeah, 4 aggressive drawdown control positions yesterday, which accounted for obviously my loss. Sorry, this, yeah, no, that was yesterday, wasn't it? 14th, yeah. DAX. Closed out 2 positions on DAX yesterday. Nice profit. That one there. And I closed out another one at break even, which was this one here. So I closed those 2 out. The reason I've closed this one at break even was because of the speed and velocity of that drop. I am anticipating potentially a pullback, and I was anticipating a pullback yesterday as well. But that didn't happen, that pullback. So I put the position back on. The EA is also taking a position for me. So I have put one on manually and the EA has taken one. So what I'm going to do is I'm just going to break even one of these, this one here. Because these are far too close together. These are only 60 pips apart. So if we push up on the DAX today, I'm going to close that one out at break even, and then the EA can get me in up there if that does pull back towards yesterday's high. So yeah, so closed those out yesterday. The DAX, pound Swiss, I got in and out of the pound Swiss yesterday. I was looking for a pound pair to take, and I looked at my exposure and I was trying to get on some pounds and I couldn't see much to get on apart from the pound Swiss. So I jumped in on the pound Swiss down here, because I was expecting the pound to drop off the back of the news. And then I did a little bit more analysis and I thought, yeah, pound New Zealand looks better. So I scrapped that one basically at a loss. And then I got into the pound New Zealand. And that was it yesterday. So that's why I had a loss yesterday. And then this morning so far, I just closed out 2 positions. So that pound New Zealand that I got into, I took one position here somewhere. I took a second position on the push up, which I got out of this morning. And this one's now at break even. So basically yesterday, trade made me a nice little profit. And Euro New Zealand, I took that one off this morning. That was the aggressive I did get on. So these 4 attempts at aggressive drawdown control, I don't normally do them this quick, but this Euro New Zealand is slightly worrying me. Not just I'm not used to the euro being this strong, and it's sort of sketching me out of it. So I don't normally take them that fast, but as we got that reversal alert, this was a nice strong move. This one, lovely big bearish engulfing. After we've pushed up and taken out the Asian levels, then we've taken out the London levels, and then we had this big bearish engulfing. So I took that one, stopped above the high, and then we collapsed. So as we started this move down, we did a lovely pullback, retest, and as we carried on down, I was watching this level here, Asian midline, and I entered the second aggressive position there as we broke down, and then we just flip-flopped through New York. And then as I woke up this morning, we were in accumulation. The reason I took that one off was because I was expecting more strength off the New Zealand dollar, because we had positive New Zealand dollar GDP figures come out overnight. I was expecting more strength from the New Zealand dollar, which we didn't get. So the fact that we only got an accumulation, I thought I'd better take this now in case we do have a pullback today. And then obviously I've got this other aggressive position on which I will nurse. But yeah, so I took that one off. So that's basically got pretty much the losses from yesterday back. We're still up 6.2% on the month. This has been one of the trickiest months I've had for a long time. After having those 2 massive 25 and 30% profit months, this one's proving a pain in the backside, like pulling teeth at the moment. But market does what the market does, and you just got to deal with what you get given, basically. So, so current positions on, I have DAX short, close to break even on that at the moment, but that's mainly because I've got these 2 positions on above my average. So if one of those stops out, the market's opening in 2 minutes. So we're either going to do that this morning or that this morning. If we do that, I'm going to be out of this one, and I'll add. If we go down, fantastic, I'm out. Well, I'm not out. I'm just going to stay in it and see where we go. Aussie dollar, US dollar, I added again to that one yesterday. So had a nice profit on that one on the news. And the EA got me into another position there. We're either going to, I think, flag and drop, or we're going to pull back into here. If we pull back into here, obviously I will short, which is absolutely fine. US dollar CAD, same story. That was the news trade, and I took a second position up there, looking for one of 2 things to happen: flag, pop, or pullback, push. So I will scale in if necessary on those 2. Pound New Zealand is the one that I took yesterday, which we've just looked at. So I took one profit off that one. That's the other position I've got on. And Euro New Zealand we know about, because I've been in it for weeks. Entry on the Euro New Zealand was down here. So still in that, on a bit of a squeeze in a minute. But this is why this is worrying me. Yeah, this is just not, I'm not used to the euro doing this. Euro's not a long. I don't think the euro's a long now. I think the euro is now a short after the rate announcement. I just can't believe the market hasn't actually done anything with it yet, but that's mainly because we've got a really weak New Zealand dollar. So what can you do? One currency weakens, the other currency weakens with it. You just get an accumulation, which is what we're sort of experiencing now. Rather than the drops, we're getting accumulations. Markets just opens. I'd be very surprised if they don't come and get that high up, but we'll see. So that's me yesterday. News today, we've had obviously overnight the news on retail. On GDP or the New Zealand dollar, which came out very positive, not just positive, very positive, which is why I'm confused we haven't had more strength. GDP figures are a reactionary news event. They do not have any impact on monetary policy from the central banks. But they are a good measure of how well the economy is doing. The economy is doing very well, better than expected. So I'm quite surprised we didn't get a better push out of it, but it's being held down at the moment, the New Zealand dollar, with what's going on in Asia. So, it's just one of those things. I'm not quite sure why the New Zealand dollar is being held down quite so much. But anyway, that's what it is at the moment. Aussie dollar figures came out negative, only slightly, 0.1 on unemployment, and a couple of points on employment change, which is nothing really. Whoops, wrong one. Yeah, obviously, as you can see overnight on the Aussie, unemployment figures came out negative, so of course it rallied a little bit. Just meh. Unemployment's not that important. But we have got a big one this afternoon again. So third day on the trot, we've had CPI, we had PPI, which is very disappointing. And we've got retail this afternoon. So retail sales quite often will move the market fairly strongly because they are a good indicator of economic pressure and recession, because if we stop spending money month on month, it means we're tightening our belts. If we're tightening our belts, it's because we're running out of money. If we're running out of money, we're going into recession and everything's becoming more expensive, which we know. So I would expect these, as forecast, to come out a little bit worse than previous. If they don't, it means that the economic slowdown isn't quite as quick as we were anticipating. Therefore, we should see a little bit more strength in the US dollar. So there is another opportunity for the US dollar to rally again this afternoon. But we'll see what happens. Retail sales don't tend to move it as much as obviously PPI and CPI figures do, although the PPI didn't do a lot. But it all depends on how big that gap is. So if we have a very large positive or a very large negative, then we will get some decent volatility. But that's all we got this afternoon. We've got Philly Fed as well this afternoon. Yeah, it's basically those three which are important. And then tomorrow we've got retail for the pound, and we've got University of Michigan. So not a lot of news tomorrow. We've got lots of options expiries tomorrow as well. So there's a potential for big volatility today and tomorrow. So that's the news. Overnight, not a lot. There we go. This is what I've been talking about for the last few months. The country lacks sufficient tools to battle the yen's steep decline. You know, there's all these bond purchasing systems and all sorts of monetary policy systems that central banks and governments have in place. They've exhausted all of theirs, and they are still unable to control the weakness in the yen. They're out of options, and it's getting to the point where, you know, they need to think seriously. Quite what they're going to do, I don't know. But this is why I'm not shorting the yen. There is nothing for them to do. They put into place lots of plans about 4-6 months ago, and it all looks like it was starting to. Not even that long ago, actually, but it all looked like it was starting to get better. And none of the plans they put into place did anything. Just couldn't affect it. So in trouble. Yeah. That's just the Aussie figures. Trade balance worse than expected for the yen. Imports higher than expected. They're out. Exports also down year on year. Not good news. It's just about gas, GDP figures, stagflation. Yeah, I know about that. But yeah, not a lot of overnight. So let's have a look at where we are market-wise. What's today? Thursday. Just about to stop out on that DAX. Oh, that's a lovely little double top. We can hold that. That'd be very nice. We can hold that and drop. Right. So weeklies, we've got a lot of weekly ranges hit. The vast majority of these, obviously, as you would expect, are US dollar. And we've got some yens scattered in there as well. So there's a few that aren't normal based on what's obviously been happening. Blimey, that's just took off. We just broke that high. So yeah, we got a few weeklies that have hit. Aussie dollar Swifts. So obviously the weekly starts on a Monday. So we've basically done yesterday that one 1400. The one, sorry, 140 to the downside on a 134. So weekly range was hit, and obviously we've had that reversal, lovely reversal alert, retest, that beautiful W pattern reversal yesterday, looking probably to come back up and retest this up here. So I just sent your comments. Morning, everybody. I haven't said morning to Stevie Tembanio, I think. Curbside, how does one adjust the size of the reversals? Mine show up in bigger blocks. You can't. You can't adjust the size of the reversals. The reversals are the reversals. Yours will be painting exactly as mine is. There's no... you can't adjust that. Morning, Alex. Andy, tricky market says institutional desks back to full strength from summer holes. Yeah, it's all picking up volatility, which is good. Can we do a live at the start of that? If possible, can we do a live at the start of that? Jeff, what was that? Retail. It's not. I assume you mean retail. It's not going to be big enough. I'd be very surprised if it was bigger. The only times I really do lives on news are sometimes on CPIs and on rate announcements. Those are the big ones. It's these are all when you've got your I keep talking about these scorecarding systems that the banks and institutions use. CPI and rates take up probably 30 to 40% of the scorecard. They are massively important. Also, building permits are very big. These are just guess figures. I don't know the exact numbers, but these three are the most important because inflation is what drives currencies up and down. Rates are what controls inflation, and building permits are one of the largest incomes and expenditures in any economic, any sort of developed world is the building sector. And building permits are issued when there is the go-ahead to build more things. So the building permits actually have a very big impact because building permits, when they increase jobs, they increase housing, which controls inflation, and they also increase material movement, manufacturing, everything revolves around those. So we need to import more stuff when there's building permits released. So the building permits, although it doesn't sound like it's very exciting or important, it is massively important. Those three make up the vast majority of what you will find on any institutional scorecard system, which determines whether a bank or a hedge fund will go long or short. The rest of it, retail sales, make up small parts. So everything else you see in red is small. So what you tend to find happens on these news events is a manipulation and then a continuation, or a manipulation and then a slowdown. So if you've had something that's been going crazy and something comes out negative, it doesn't mean it goes like that. It means it normally just stops going as crazy. Might continue, but it's just, think about these like the accelerator pedal in a car. When those three kick off, you're basically slamming your foot down and you're going to get that movement. The rest of them are like you gradually pumping the brakes on a corner and waiting for it to move, And that's what retail sales are. You'll find you'll get big moves. You'll get an ADR hit off it sometimes, but you'll usually find if you do get that, you get a fade and then a continuation. Or if it's been moving up, you'll get an accumulation, which is kind of what we're seeing on some of them now. And then you'll get that next push, but it won't go crazy. Doesn't normally anyway, unless it's absolutely massively out. And that is the case with any red news event. if it comes out like, if you look at the averages and the means on everything here, we're usually talking like a 0.5 divergence there, a 0.3 divergence there, 0.2 there, a 0.2 there, a 0.1 there. So we're ranging from 0.1 to 0.5. If it came out at 1% different, yeah, the market's going to go nuts, because it's like, well, we don't normally have anywhere near that difference. Something's going really well or really bad. Like here, for example, February the 16th, we had a 3.3 on a forecast of 1. US dollar, Swiss color. Can we go back that far? February the 16th? Yeah, big one there. Don't seem to have had much movement on that one. Yeah, so that would have been released there. And we got a 40 pip move, so about half an ADR. Yeah, so do you see what I mean? It's, even though that's a massive divergence, that's probably not a big divergence then. I can't remember what was going on around then, but yeah. So basically, it's actually, yeah. If you look at it, actually, the forecast. This was forecast to go from -3 to +1. So they were forecasting a 4% change, and all we got was basically a 6.3% change. So it's not actually as big as it looks. But yeah, so this is what you're going to get off of retail. Quite often, you'll get that manipulation. You won't get that massive move, and the market was already coming down, accumulating, and it just helped the market to continue in its direction. So they're not big enough really for me to sit, because we sit here and literally we go, well, that was boring, as we have done with some major news events in the past, obviously. So does it influence mortgage borrowing, Trevor? No. So building permits don't influence mortgage borrowing. Well, they can do. It depends on what the building permits are being issued for. Building permits aren't just about creating housing. They're about creating skyscrapers, business offices, industrial, converting brown belt and green belt into residential, all sorts of stuff. But normally building permits are housing, most of it, because that's what most of the world needs, is more housing. But it doesn't really impact mortgage rates or mortgage borrowing as such, because you will always find that within any building, there is always a demand for housing everywhere. And the housing is split between affordable housing and normal housing, as you would expect to go and get a mortgage on. Lovely bearish engulfing forming on the indices just while I'm talking. Not that one. What am I looking at? Oh, NASDAQ, that's why. Just started to reverse off of the highs there. But yeah, it doesn't tend to affect it too much. You will get more borrowing, obviously, because more people need to buy houses. But it doesn't make a massive amount of difference. All these car analogies sounds like Swiss Paul in the car dealer from the fast show. Yeah. The fast show. God, that's a blast from the past. But yeah, I mean, it's always going to be good for banks. But when we're talking about putting up 3,000 more houses, you'll always have this cycle of people completing their mortgages and new people starting their mortgages, people completing their mortgages. So the mortgage levels don't change dramatically, not enough to really affect anything. And that isn't something that really affects monetary policy because that will be reflected in the CPI figures, basically, and the PPI figures rather, from the banking sector and stuff like that. Looking forward to scalp using this strategy and bank 20 to 30 pips per trade and pair. Time frame is going to be M1H1. That's a long way away. I'd go M5H1 rather than M1H1. Basically, if you're trading M1, you don't need to have a higher time frame because you're just trading complete chop. It's a complete randomness. M1, all completely random. And if you're scalping this, I mean, just spreads a nightmare. M1's a very, very difficult time frame. If you're using M1, I'd use M15. 15 candles apart. That would be my recommendation if you want to do that. But it's very hard. Much nicer. There's your... You're just basically trading all of this stuff here. Kill you. Over and over again. Look at that. Like you long that break. Stop under there. Stopped out. It's just chop. M1 is just chop. If you're in, you've got to be out within a candle. That's the type of scalp. If you're going to scalp these time frames, you want to be short there, you want to be out there. Otherwise, you're just going to get chopped. Look at the wicks. There's no price action on M1. Just wicks. This is the open as well. This is when it's busy. Wicks, just wicks. You just get wicked out all the time and spread out all the time. Nightmare. But if you think you can do it, do it. I just don't know. I don't know anybody who makes money out of M1. If RSI is overbought on M30, look to buy a pullback. Yeah, but again, I would warn you. RSI gets extended for a session. An entire session, you'll be extended. If you were scalping that, sure, yeah, you got murdered. Just basically trying to catch a top in a market that's trending. If you're using the RSI on M1, it just doesn't work. Try it, but do it on a demo. Try it for a week on a demo. If you can make money after a week on a demo, go for it. I just think it's so difficult. But is M30 a proper chart to use? Yeah, a lot of people use M30. Well, I say a lot of people. I don't know many people, but yeah, I mean, M30 is just in between M15 and H1. It's just another... Don't forget, timing, we as traders use these candlestick time frames because we operate in time. The market has no interest in time whatsoever. This is why it's impossible to time the market. You know, it doesn't matter what time frame you're looking at. You're looking at price action moving from A to B. The market moves from level to level in price discovery, finding out if there's people available to buy or sell. If there isn't, it will move around and it will find people to buy and sell. That's what it does. Because if it doesn't, it can't transact. How long it takes to get somewhere is totally irrelevant and nothing to do with anything but the button that we press here. Yeah. If the market wants to move from there to there, it could do it in 1 day, or it could do it in 3 days, or it could do this and do it in a week and a half. It all depends how many market participants are in the middle. And no amount of changing this is going to affect that. We as human beings need to rationalize this chaos that we see on M1 into manageable chunks. Therefore, we invented timeframes. No market participant uses that. No futures trader uses that. It makes money. They use price and they use orders. and they use where price has been to show where price is likely to go. They have no idea how long it's going to take to get there. So looking at that doesn't make any difference to you as a trader, apart from the fact that it gives you different places to put your order for the market to come and grab. So if you're trading M5, this is quite a good lesson actually. Took me a long time to get this in my head. If you're trading M5, you've got way more opportunities for the market to come and grab your stop loss. Let's use a different pair because this is too manipulated. So let's just look at since this week, Monday here, right? So you've got 1, 2, 3, 4, 5, 6, probably 7, 8, 9, 10. I don't know, it depends how many you want to look at. But there's 10 or so opportunities for you to pick highs and lows there on the M5 time frame. And price went a total of about an ADR on Monday. If you went to M15 on Monday, you had 1, 2, 3, 4, 5, 6. Gets more difficult to pick highs and lows, doesn't it there? So the number of highs and lows disappears. Got to an hourly chart on Monday. We're now talking 1, 2, maybe 3. You go to a 4-hour chart. You can't even see Monday now. But it's all flattened out, isn't it? So all you're doing is you are creating opportunities to put more orders in the market, the lower the time frame. Yeah. And that creates more opportunities for the banks to come and get them, which is why I say when you go down to M1, all you are literally doing is putting liquidity in the market for it to come and grab. And it doesn't matter where you are. Yeah. Look at that move in Asia. What is that? That is the market taking out every single person that has entered in the last 4 or 5 hours. Yeah. It doesn't know where it wants to go. The market at this point in time, right here, hasn't got a clue if it wants to go long or short because it doesn't know what the book balance is here. It doesn't know whether or not it needs to go long or short to make money. And it doesn't know where the next batch of orders is at the moment. But what it does know is it's got that lot. So now we're in a position to move south. So this is a really good example of how the banks operate. Accumulation. Okay, we've taken every single order in the market and we have a negative book balance, which means we are short, which means that if we go short now, the market goes short now, we will make $1.2 million, for example. I have no idea what the figure is because I have no idea what volume's in there, but let's say, for example, they can make 1.2 million by going short. They would just execute tons of massive sell orders down there, and they will just buy it back up again when they've executed the short and made that money. Yeah. You're looking at complete chop, random chaos, or most of it controlled by algorithms. You can't predict anything on that. If you look at it on a 4-hour chart, yeah, we know at the moment we're in an uptrend, so we want to be buying it. On that 1-minute chart, you have no clue. No clue. Yeah, it's just time frames are created by us. So the M30 time frame, there's a few people I know that use it. I don't know many. It's just one of those weird ones that sits in between M15 and hourly that nobody ever seems to look at. But it does smooth the market out quite nicely. You look at M15 and you look at hourly, M30, all you're doing is you're getting a little bit more movement shown to you and probably a couple more opportunities that you may not have seen, like there. That's still there, isn't it? There, it's just smaller. I don't know. I just don't use it. I've never used it. I think for me personally, I've never been on a course or had a mentor or really had anybody ever say the words M30 to me. So I've never looked at the thing. I know there's a guy on YouTube that trades nothing but M30 on pound yen. I think it's Raja Banks, isn't it, or something? Wicks don't lie guy. Doesn't he just trade M30? You know. But yeah, I don't know. I don't use it. But there's no reason. Use it if you want. I just don't know what it pairs with. You know, hourly goes really well with M5, M15 goes really well with 4 hour. Daily might be the M30. I don't know. Maybe daily M30 is good. I would go with daily hourly because there's 24 candles difference there. There's 48 candles difference there. It's just you got to try it, really, I think. Emra, can I check gold? There you go. There's gold on M30. Is there a particular reason you want me to check it? No. There you go, I've checked it. What do you reckon? You tell me what to do here on gold. I've no idea. Gold's a short for me. That's where I would have shorted it. I don't short it because I don't trade gold. We're just taking out liquidity. So if you get a bullish close on 4 hour, potentially got a good long play up into that propulsion gap, which has acted as resistance so far and is likely where the next sell rally will start from. If not, if retail figures come out as positive and the US dollar pumps this afternoon, it's just going to come down. It's just a cross with US dollar. So, you know, just treat it in the same way. Everybody keeps asking me about gold, and, you know, the answer is the same. What are the other US crosses doing? Yeah, so you've got loads of US crosses. Yeah, all these US crosses you've got. They're all the same. What US dollar does, it will do the opposite too. It's just a US dollar cross. It's just more volatile because the thing that is crossed with has more volatility because large amounts of it get moved from country to country. At the moment, though, it's massively trendy and lovely and looks beautiful because Russia has a gold export embargo on it, and Russia holds most of the gold, and therefore most of the gold is not moving. So it's just trending very, very nicely at the moment, which is why I would say, you know, ask yourself the question: do you want to be long or short on that? You should know the answer to that. How many max numbers of entries have you entered on any FX pair until now? Oh God. I couldn't say. On one pair, I've had up to, I've certainly had 15 entries. I don't know what the max is. The thing is, with me personally, this is never, like, for example here, this is not 8 full positions on Euro New Zealand. Yeah, when I get to 5 positions on, I'm wrong. Yeah, I'm temporarily wrong, and I'm wrong for longer than I thought I was going to be wrong. So I start doing aggressive drawdown control. So on the Euro New Zealand, yeah, my lot size is 0.26. You can see these are 0.13s here. Can't see that one. Oh, sorry, there's only 2. So these are not full-size positions. So this is 1 position. So I've actually got 7 full positions on. Actually, I haven't. I've got 6 full positions on and 1 aggressive drawdown control position, which happens to be sitting on top of the reversal there, because obviously the EA got me into a second position with that as well. So I don't know the answer to that, but when you get, if you're spacing out half an ADR, which is what I recommend as a minimum to space your positions, right? If the market is pushed against you by 5 positions, you are 2.5 ADR away from your initial entry as a minimum. So the market has pushed 3 ADR away. At that point, based on many people's theories, including Steve Malrow, you get a 3 ADR push, which is where we tend to look for our peak formation. So when you get a move, a buy cycle, the buy cycle will usually last somewhere between 2 to 5 ADR. Could be anywhere really between 2 to 5, but typically 1 to 3 ADR is a buy cycle. Then the market will either accumulate and move up higher, or it will accumulate and more typically go into a sell cycle, which is the buyers taking profit on their moves. Yeah. So when you get to 2.5 ADR, half ADR spacing and 5 positions, that is where you will be. That is typically when you will see the market start to roll over. If I get beyond 5 positions, I'm wrong. And the market is not rolling over. And this is why I keep preaching about keeping your average within 1 ADR, because the market will often put an ADR push in. It's either massive weakness on that or massive strength on that. When you get squeezed, what is happening in the market is the thing that you were shorting and the thing that you were longing, in this case, I'm short euro, long New Zealand. What's happening is in the market, the euro has found some power and the New Zealand has found weakness. So the opposite of what my expectation is happening. Yeah. And that is why you get into a squeeze. And that is when I get into more positions. So position number 5 for me, or usually around about 2% in drawdown, is where I think, right, I'm more wrong on this than I thought I was. So I need to do aggressive drawdown control. That aggressive drawdown control can be executed from anything. I can take profit from here and remove some of this. Or as you see here, I do aggressive drawdown control positions and use that to start reducing the lot size down here. So although it might say at times, and I've seen many times I've been 10 to 15 positions, they're not full positions. If I had 10 to 15 full positions on, I would be in massive, massive trouble. So you don't let it get to that point, which is what drawdown control is all about. You are temporarily wrong most of the time, i.e., when I get into a position, everybody that's been in here for any time will contest. This is the norm. Somewhere between 3 to 10% in drawdown is the norm. This is me using my account leverage to make money. This is me putting risk on. This is my risk at the moment. But the worst case scenario right now, I could close it all out and I'm going to lose 4%. I've made 6% this month. Yeah. So worst case scenario now, I can just shut the lot and walk away with 2. That's not what I want to do. What I want to do is manage this risk by using what was working, i.e. I get into a position and it works straight away, to offset against stuff that is going wrong. Euro, New Zealand. You don't know what's going to go wrong because you don't know what world economic events are going to happen. You don't know what's going to strengthen, what's going to weaken. You just don't have a clue. No one does. If we did know that, we would all be multi-millionaires, wouldn't we? We don't know that. So we have to just get into positions and use our heads really to get out of those positions when we're wrong on them. But your normal temporarily wrong position, which is a normal position trade, you'll get into it, you'll scale into it 2 or 3 times, maybe 4, and then you'll get that move back down, that push, profit take, push, profit take, push, profit take. Market structure. As long as you have market structure in the market, you have an opportunity to escape the market with a profit, because everybody that buys has to become a seller to escape. I have to escape by becoming a seller. What was I here? A seller. What am I at the moment? A buyer. I'm doing the same thing. I'm buying, I'm selling. I have to get out of my positions. So that's basically max number. I don't look at that really. The higher it is, obviously, the worse the position is. But this is the most important thing. This is your comfort zone. And everybody's got a different one. For me, anything over 3% here, I'm like, really, really wrong on this. I've got to sort this out. I need to get aggressive. And I will get really aggressive. As you saw yesterday, yeah, I'm getting really aggressive on this now. I had 4 attempts at drawdown control. It's not often I have 4 in a row that go wrong. The 5th one worked. The 6th one at the moment is also working. It's not often I get 4 wrong. But by the time you get to that, the market will have moved so far against you, the odds of it coming back down because the market needs to take a profit are so much higher. That normally happens. And that's exactly what I caught yesterday. Yeah. Because the market is so extended. Yeah. And think about it, you know, this is the whole thing with the RSI. If the market has pushed to extended levels and hasn't done a big enough profit take, and then it manages to push to extended levels again, hasn't done a big enough profit take, then pushes up again without a profit take move, it is massively extended. Everybody sitting in this thing now is waiting for an opportunity to sell. And as soon as that cascade starts, market structure breaks to the downside, we will start a selling frenzy. Buy cycle, sell cycle. We're just waiting for the sell cycle to start. And again, brings me back to this. I've no idea what time frame or how long that sell cycle is going to be before it begins, and I don't know how long it's going to last. I just know it's coming because if the banks don't take profit, they don't make money. They've got to. The only time they don't is when you have a fundamental shift. And the banks get caught the wrong side and it goes away with them. You get a load of people making losses and it flies. And that's what we've seen with things like US dollar yen. Yeah. 5 ADR push, 5 ADR push, accumulation, 5 ADR push. Yeah. That's a squeeze. That's a trend direction. That is the yen collapsing on its backside with absolutely no monetary policy tools they can use to reverse the problem. And the US dollar powering up. And this is what I was saying yesterday to somebody in the Telegram group. Always try and stay in line with the trend if you can. I used to stay in line with the COT report. The COT report has become less and less and less effective. So I'm using the good old 2472, which is what's always been on my charts. And that's what I want to take. You know, and if this thing collapses 3 ADR against me as it did there, let's pick the trade actually I did, Swiss yen. So this trade here that I took, that short, bounce off the 24 was what I was looking for, didn't get it. Moved down 350 pips, so that was just about 2.5 ADR against me. Scale in, scale in, scale in, out. But that worked really well. Why? Because the market is buying. Everybody's buying at the moment. Everybody's buying. What do you do in a trend? What's everybody say? You know, go to Baby Pips and what is the definition of a trend? They'll tell you what a trend is. It's higher highs and higher lows. And then higher highs, etc., higher lows. Yeah, we know what market structure is. Yeah, that's a trend. Going up. What do they tell you to do in a trend? Buy the dips. So when you're buying, as the market's coming down, you're buying full well knowing that the entire market is looking at this as an opportunity to buy it, because that is what's been happening. The only thing we can do as traders right now at this hard right edge is look left. And the only clue we have is what has happened in the past. And that is what everybody's doing, and not just you and me. That is what the banks, the institutions, and everybody else is doing. What is monetary policy at the moment? It's bullish. What is the market doing at the moment? It's buying. Until something changes, that will continue. When you have a fundamental shift, like a rate change that was completely unexpected, we see structure shift. This thing's trending, squeezing. The Swiss franc went, actually, we don't like that because we've got a tool that can stop this going any further. What did they do? Increase their rates without telling us. What happened? The market went, okay, now we're going in a downtrend. Yeah, fundamental shift. Until that happens, and this is why you have to be so aware and so careful of news. You've got to be aware of what's coming up. What could potentially be changing in the market in the next couple of weeks that I need to be aware of when I'm getting into a position which could last for a couple of weeks. Why do you think I'm stuck in this? Euro. And what did I say when I took this trade? I will regret this. I knew I would. I didn't think I would. Obviously, I wouldn't have taken it. But I was very cautious about it. And that's why I only took €1 short, because I knew we had a rate change coming. And the rate change has worked out in Euro's favour. Not massively. But yeah, so anyway, that all came from talking about if 30-minute is any good or not. So, sorry about that. It's important to know all that stuff. Very, very important. Which is why, if you're trading M1, you don't need to know any of that. If you're trading M1, M5, just forget the whole lot, chuck it away. Everything I just said, totally irrelevant, because you're trading the chop intraday. You're in and out within 5 or 10 minutes. Whether the company's going up or down long term has got nothing to do with you whatsoever. It could go up or down today. I have no idea, no clue. It's a completely random thing. It's the bank basically building positions, deciding where it wants to go next. So forget it all. If you go to trade M1, M5, doesn't make any difference. So there you go. Also, rising interest rate. I'm not very bullish for gold. No, rising interest rates are bullish for the US dollar, which is bearish for gold. Exactly. Yeah. Remember what I said? This is a cross with the US dollar. Interest rates, inflation, which is what we've got, is good for the US dollar, which is bad for gold. Interest rates hiking will get on top of inflation, which will be bad for the US dollar, which will be good for gold, if they can get on top of inflation. But interest rate rises on their own will not necessarily move this in one direction or the other. When we see the inflation figures coming out and we see inflation doing that, or that in this case, that is when the market will start to change its direction. Because it doesn't matter how many times you raise interest rates, if inflation keeps going ahead of interest rates, you can just keep doing this. And this is what we had in the UK in the 70s. This is why we went up to 15% on our interest rates or whatever it was, because they kept raising interest rates, but inflation was getting ahead of interest rates. You've got to catch and get on top of it. And this is why this problem is happening at the moment with all these 0.5 increases on the interest rates. It's not helping. 0.75 to 1%. That is going to get ahead of it a lot quicker. Yeah, it's going to make the world poorer. Unlucky. Well, tough. We're in a recession. Get on top of it. The countries that are fast moving with their interest rates are going to get on top of inflation quicker. But everybody's dragged down by the US because the US is the largest economy and we tend to follow it. So we're relying on the US getting it right. If the US don't get it right, we'll all stop. Nothing we can do. We're in the hands of the Fed, and that we will find out next week. Steve Melro, Rocky, laughing. Steve Melro, get me wrong. There's a lot of these big guys out there, like Steve Melro and ACT and all these massive gurus that you never ever see take a trade. I never have seen take a trade. They have these amazing courses and theories on stuff. At the end of the day, it's all driven by fundamentals. But they're right, and all these people like Steve Melro, the three ADR push is part of what he teaches in his course, and it's right. But the reasoning behind this is because of bank movement and price discovery. That's what is behind it. But, in layman's terms, yeah. Well, why do you think I use ADR? Very important. I need to know what the average daily range is, and I need to see when we're doing multiple pushes. But I don't. And I had an ADR dashboard, which 3 years ago when I first developed the indicator, it had peak formation high, and it had a measurement of 3 ADR away from price. And I dumped that completely because the success rate of it was ridiculously low. If you actually look at 3 ADR pushes, look at that, for example, that's 12,000 pips on a 225 ADR. That's 10 ADR push. That doesn't conform to the 3 ADR move theory, does it? So it was a theory which very quickly I disproved. It works a lot of the time, but a lot of the time it doesn't. And this is the problem with everything, isn't it? Everything works sometimes and doesn't work others. And everybody then moves on to the next thing, looking for the thing that works better than the last thing. And then suddenly you'll realize that everything works the same amount, which is most of the time not. And the reason is nothing to do with the system or strategy. It's to do with the fact that you place an order there. When you do that, they come down and take that order and then do that, and you get cross. You are the problem, not the market, the system, the strategy. But anyway, we've discussed that. The ends of the earth. If charts look different from one broker to another, it's broker manipulation. My TP on highs was just inaccurate, 30 pips spike up. No, yes, charts will look different on different brokers based on a number of things. A lot of the time on the spread, the swap. That will be where you'll get a lot of differences in charts. With indices, some brokers have overnight price action, others don't. That will make a big difference. Your moving average will be affected, your RSI will be affected, your ADR will be affected, all indicators will be affected. One of my mentors, when you're first starting out in trading, and I get asked this all the time, can I have your template? Can I have your template? Because I want to look exactly like you. You won't look exactly like me because my charts are going to be slightly different to yours. His answer whenever I said, why does yours end there and mine end there, was don't trade my charts, trade your charts. If your charts give you a reverse alert and my charts don't, because your broker had a high there and my broker had a high there, trade your chart. You got a reverse alert, you take that risk. The chances of this trade working out is still 50-50, whether I had it or not. I just don't take that one, I'll take the next one. You won't take the next one because you won't get a reverse alert on it. Trade your own chart. And they're going to be out slightly. They're not going to be out massively. You know, we have people all the time saying, I've got an ADR hit. Yesterday, Diamond had an ADR hit at 150 on something. We didn't, because his charts are slightly different. But it's general. You know, whether it hit 150 or it hit 137 or 117, what is it? Extended. Yeah, it's very stretched. Whether it's stretched to 150 or 125 or 128 or whatever it means, it doesn't matter, does it? It's extended. Yeah, when it gets above here, it's had a busy day. That's all you need to know. It's had a really busy day. It's had a very busy day. It's had a fundamental shift. Whatever, it's a push. And we're just looking for opportunities. And don't worry about whether it's hit that to the pip. Yeah. We often find ADR hits, and that's because the market has a finite amount of money to move with. Banks have a finite amount of money to move the market with, and that's why ADR works. But it will only work when we're going to be in a rotation day. If we're in a trend day, it will quite often break it, and then pull back, and then break it again, and that's what you trade. So, you know, don't worry about how far it's gone. Worry about when it's starting to move, and that's what this tells you. It's moving. Yeah, it just, you know, don't worry too much about the fine details of charting. It's not the be all and end all if you're 10 pips, 20 pips out. But it's TradingView a good neutral chart. TradingView is a broker view. So when you look at any chart on TradingView, that data feed is coming from a broker. Or if you're looking at futures, it's coming from CME or it's coming from NYMEX or wherever it's coming from. But it's a broker chart. And you'll see when you say, I want to look at Euro US dollar on TradingView, there's loads of Euro US dollars come up. One by FXTM, FXCM, one by so-and-so, one by so-and-so. They're that broker's view. So whether you're using MT4 to view FXCM's feed or you're using TradingView to view FXCM's feed, the feed is the feed. And don't forget, these are CFDs. These are the broker's approximation of where the market is. And it will always be within something or other. There's always going to be a little out. But that's what I say, use your charts. My low is 12,942 on the DAX. Your low might be 12,935. It might be 12,952. Yeah, but we're not looking for that. We're looking for this area down here to be an area we might move from. Not looking for a to the pip thing. It's just not, doesn't work that way. Support and resistance doesn't work. It's an area. This is why I'm always wary of going with the trend, because it will change just as I get in, Jane. Yeah, that's the trouble with trend trading. And again, I've said this before. With a trend, we're not doing much analysis today, are we? But it's good to talk about this sort of stuff. The problem with, there's the age-old argument, and I've got a video on YouTube actually about this. Should you be a trend trader? Should you be a mean reversion trader? Or should you be a breakout trader? Yeah, these are the three main styles of trading. Yeah, trend, you only go in the direction that the market has been moving. Mean reversion, you only go against the way the market has been moving. Breakout, you take moves in line with the market movement or against the market movement. Yeah, every single one of them has a problem. If you get into a trend, yeah, first thing you've got to be able to do is identify a trend. A trend is something that is moving down. So you go, oh, look, this is trending. As you get in short here, it goes that way. That's the problem with trend trading. Yeah, at some point that trend is going to end. And normally it's when you get in, because by the time you've identified the trend is ready to pull back or reverse. If you're a mean reversion trader, you're trying to catch a falling knife. You're trying to trade against the trend. And basically, trends have a much bigger chance of continuing until they don't. So if you get the mean reversion at the right time, you're awesome. But you will have to take hits along the way to get that trade. So if you take 4 losses to make 1 massive gain, and that massive gain is bigger than normal, bigger than your losses, you're a winner. Yeah. Breakout traders. We know very well that a lot of breakouts are false. So we pulled up, we pushed down, you took a breakout short, it pushed up, took your stop out. You failed. Yeah. You took a breakout here, it moved up, you moved your stop to break even, it pulled back, took out your break even stop and pushed. You failed. Yeah. The problem with breakout trading is you've never got faith in a breakout, because you know damn well, and you've seen it 1,000 times and it's ingrained in your brain, that most breakouts fail. Because what are they? Liquidity runs. The market looking for stops and limit orders. So when you take a breakout, the first thing you want to do as soon as that breakout's gone, because you're worried about it failing, is get your break-even stop in as fast as possible. So the market comes down and takes those out before it goes. Yeah, every single one, whether you want to be a trend trader, a breakout trader, or a mean reversion trader, has an inherent problem, and there is no solution to that problem. And the sooner you identify that, you will just stop worrying about it, and you will just start trading and think, I'm going to get taken out of X number of positions if you use a stop loss, and you just got to deal with it. You start playing the numbers. Yeah. Ideally, what you will have is a strategy for each. But that's very, very complicated to execute, because when you've got a trend strategy, your mean reversion strategy will disagree with your trend strategy. And your trend strategy will disagree with your mean reversion strategy. Your breakout strategy will disagree with both. So in your head, every time you see a mean reversion entry, the back of your brain that says I'm a trend trader will be going, I can't take it because it's trending. Every time you see a trend trade, the back of your head will be, mean reversion trader will be going, you can't take that because it's going to mean revert or whatever. It's just, they don't work together. Yeah, I am a mean reversion trader in line with trend. That is my goal, is to take a mean reversion. And a mean reversion is a push up and a pull back to the mean. Fibs, think fibs, yeah? A typical mean reversion is this. We push to a point where we get exhausted, and then we take a profit. We revert to the mean of the move. Yeah, whether that be in line with a trend, against a trend, or what, is irrelevant. Mean reversion is a push and a pull. What I am trading is extensions, exhaustions, ideally in line with the trend, but Doesn't have to be. And this is why I keep saying, take your trades, trade your charts, experience all the different types of trades that are out there. You're going to get squeezed on some, you're not on others. The best trend trade in the world, where I thought we were going to get a bounce here, don't get it. Swiss yen, prime example. Swiss yen is an absolute prime example, of me mean reversion trading the trend. The trend is up. Look what happened last time. We pulled back to the 24. That is what I was playing. I got in there. I got in here somewhere. Because we're extended. It didn't mean revert. I was looking for that. It didn't mean revert. What it did was continue in its current short-term trend. You look at this with a 20 and a 50 MA on a 15-minute chart or an hourly chart. That's a clear downtrend. All prices way below the 20 and the 50 here. So everybody that's trading these small time frames is shorting this. I'm long in it because I'm trading a bigger time frame, showing me a bigger move to the upside. Again, pick your time frame, stick to your time frame. If you keep switching around time frames all the time, you're going to confuse the hell out of yourself. Right here, the market's telling you to go long. There, on M5, if you were looking at M5, it's telling you to go short. How confused are you? You need to be doing both. What do I do? I don't know. Ugh. Let's hit a button. That's where everyone gets really confused. This is why, you see me every time I'm doing analysis, I'm looking at H4 because I want to see where this thing's going long term. Because if I'm going to get into something, I need to know if it's going wrong, that the market's on my side. Look at this here. Where are we? It's a good example. 27th of July. Yeah, so that on the 27th of July there, at that point, you would have had moving averages. You'd have had a 20 doing something like that. You'd have had a 50 doing something like that. Yeah, at that point, the 20 would have crossed the 50. From that day onwards, everybody looking at M15 or lower on a time frame is saying, we're in a short, we're in a downtrend. Everybody, yeah. And this is why in Telegram groups and Discord channels, you will have everybody arguing. Because everybody that's looking at low time frames is saying, you've got to short it, you've got to short it, you've got to short it. Everybody that's got half a brain is looking at hourly and 4 hourly is going, it's a long, you're wrong. They will be right, they will laugh their heads off and they will go, look at me, I took a short there and I got out here and I'm the best trader in the world. Whereas everybody on the high time frames will be hitting the button down there and going, I'm going long. These guys will all be laughing their heads off. These guys will all be laughing their heads off. Doesn't matter, they're both right. Both right. They've both got good strategies that work, they've both got strategies that have made them money. You just got to pick one and stick to it. Because if you don't stick to it, you're just going to confuse yourself. So, there you go. I don't know where that came from, but hopefully that's helped somebody. Oh, we'll do some analysis in a minute. I need to look at the charts. There's lots of questions coming, and that's why. Which is good, because this is what this is for. It's for picking my brain. Andy, Steve Malrow ended up adding more and more things to his strategy, like harmonic patterns. Shows he was struggling to make his original theory work. Yeah. And this is then that's a really good point. I'm not going to labour this point too much, but when you watch the Boocamp, you will see me doing and saying certain things. In the last 2 years, the market has flipped on its head. It's completely changed. You've got to adapt. If I find that this stops working, I will stop using it. If the moving averages, if the 24 and the 72 stop being respected, yeah, I will stop using them. And I will find something else that works, because you can't rely on something working all the time. If we get into a situation where World War III breaks out, this market is going to be so flat and range bound, there will be no moving average you can find that will ever work. You'll have to find something else. And at that point, I might go through and look at Bollinger Bands and start thinking I might use Bollinger Bands, maybe. I don't know. But whatever you set up as a strategy will work in a market condition. Every strategy is either a trend-based strategy, a breakout strategy, or a mean reversion strategy. Go and find me a strategy that doesn't conform to one of those three. You can't. Yeah. Steve Malrow, with his strategy, had lots of bits and pieces in it. There was the shark fin. I'm trying to remember. Years ago, shark fin. There was boxes, wasn't there, where you would look for targets which were X amount of movement away, a bit like ADR. But this was a pip count, and a pip count is wrong. You can't use a pip. I think it was, I don't know what it was. People will probably shout at me in a minute, but I think it was 50 pips or something from the Open of London or something, was the zone. If it got in there, it was coming out of it. 50 pips on pound US dollar and pound New Zealand compared to 50 pips on euro pound. 50 pips on euro pound. It'll never hit the bloody thing. It's only got a 63 ADR. It's never going to get to 50 pips. Apart from when it's doing ADR, and yeah, then there's probably a chance it's coming down. So everything was revolving around pips, which was the first problem with I saw with that course, was you can't use pips because pips are different. Yeah, we know that. Yeah, this is 74 pips, that's 58, that's 111, that's 130. We've got nothing in 200s at the moment. 157, 177. If you're using 50 pips as a measure, what you're going to get on that pair and that pair is going to be completely different. Can't use it. Doesn't work. Pips is just utterly pointless. I don't know who came up with pips, but they're stupid. The most ridiculous measurement of price movement I've ever heard in my life. But yet, everybody wants to talk about them. So I'm not surprised his strategy stopped working. And then he moved into harmonic patterns. Harmonic patterns were initially created by Elliott, the Elliott wave theory. What is Elliott wave theory? Market structure. 1, 2, 3 push, pullback. 1, 2, 3, 4, 5. A, B, C, D patterns. What are they? Market structure. Yeah, it's price moving in waves. Why does it move in waves? Because banks need to take profit on moves. All revolves back down to one thing. There's 10 banks that control this market. You have no idea and no clue where they're going, so stop trying to predict it. Get in, get out when you see market cycles starting and ending. Likelihood of a market cycle ending. Why? Because it's pushed so bloody hard, the banks have got to take some money soon, otherwise they're not going to make any money. That's the way the market works. That's all you need to know. Everything else fits in around that. And however you use, whatever you use, you know, we had discussions yesterday in the Telegram group about the RSI. Should we use the 21, the 14? Have a look. I settled on 2 different ones because I found that the 14 works better up here, and I found the 14 didn't work as well down here. I found the 21 worked better. But that was me, that was my analysis, and that's what I thought at that time. Now, if I suddenly start making a loss month after month after month, I'm going to stop trading and I'm going to look at why. And I'm going to go, well, hang on a minute, why is the market not reacting when the 14 is extended anymore? And I'll change this to a 21, a 7, a 28. And I'll go, seems that price isn't quite moving as hard and fast as it used to. Let's move over to the 28 at the moment because that one seems to be performing better. Adapt. You've got to do it. And again, I keep talking about backtesting. That's why no backtest will ever work. You backtest a strategy that works perfectly from 2016 to 2020. You stick it on a chart in 2020, you blow your account. Why? Because COVID happened. What happened after COVID? We went into a recession. We weren't in a recession 10 years ago. So you backtest the last 15 years in Strategy Tester, guarantee for the next 2 to 3 years you'll get a completely different result because we're going into recession. We weren't in one then. I was saying to my wife the other day, we were talking about the stock market and she was asking about inflation and stuff. And I was saying, look at what the S&P normally does. We have the odd blip every now and again. We have the odd pandemic. But look at what the S&P normally does. Look at what we've been doing since December. Since December this year, we have had nothing but downward movement. Has this ever happened before? Not in my memory. What's coming? I have no clue. This has never happened before, so I've got no way of knowing what's coming next, have I? At all. What I do know is, if the banks want to make money, though, they're going to do that. As long as they do that, I'm in. That's all I need to know. I don't care which direction this goes. There will be a way for me to get in and a way for me to get out. I just need to know that it's going to move, and that's the thing that changes. the amount of movement changes. The ADR changes. I've said it before. 3 years ago, 4 years ago, I was trading pound New Zealand at 350, to 450 ADR. Now I'm trading at 157. Do you think I've had to change my strategy? God, yes. Totally different. Because what I was trading back then didn't work as well. What I was trading then won't work now. Because it's changed. You can't unfortunately change that. It's just the way the markets are. You got to change as the markets change. Unless you're an algorithm, then you can do what you like. You're just a very complicated one. Diamond, yeah, that was GA, moved back 1 ADR for me, closed out 0.5% gain. Yeah, exactly, yeah. Alan, you got different lows on the DAX, yeah. Yeah, so you're going to have different lows in different places. Alan's got a low at 129.49.9, mine's 129.41.7. The difference between those two is very little. Uh, 29. Yeah, so that's Alan's price, that's my price. It's not going to be the same. But this, with things like this, and this is what you need to understand, with things like this will throw your moving average out because your average is going to be different. Your RSI will be different. You may or may not get a support rectangle formed here or here. If the support rectangle won't form until the market has moved in this particular distance, you won't get a reversal alert when that pushes. I will. Yeah. Trade your chart. If you get one, get one. You're going to get different signals, different times, and that's just the way of life. Unless everybody in the world trades on the same broker, we are all going to see something different. And that's why futures is so amazing. Every single person trading futures in the entire planet is seeing exactly the same price because there is only one feed from the Chicago Mercantile Exchange, and they feed it to every single human being on the planet. Futures is futures. Everybody sees the same thing. That's why futures move so well, because you get something moving into a block of orders where you see 250 contracts short, and they keep adding to that 250 contracts short every time we tap into it. You go short because the entire world is seeing exactly the same thing as you. Futures moves to the tick, which is why everybody scalps it, because you can scalp futures on M1, M5, because everybody is seeing the same thing. When we all see the same thing, we all do the same thing. What are we all? Sheep. We follow each other around. Yeah. The Queen has died, unfortunately. What's everybody in the UK doing at the moment? Either going to London this weekend or contemplating going to London this weekend. We're sheep. We do the same thing as everybody else. Traders do the same thing as everybody else. They see something coming down, they sell it. They see something going up, they buy it. You have no control over it. The banks are what are guiding the sheep. Probably better rats. We're probably better called rats, aren't we? The banks are the Pied Pipers. We're just following them because that's what we do. Jane, this is why I like basket trading. Exactly, and this is why I came up with it. I didn't come up with it. It's not a new concept, basket trading, position trading. It's what the banks do. Yeah, it's called dollar averaging. But you've got to be careful with how you do it. It's got its pitfalls, like everything. Every strategy has a downside. The downside of position trading is squeezes. When you get squeezed, you have to do something about it. You saw me this month, oil. If I hadn't have been squeezed by oil this month, I would be sitting on something like 14 to 15% now. I did get squeezed by oil this month, and I'm sitting on 6. I didn't know I was going to get squeezed by oil. But what annoys me more than anything is I knew what was going to happen to oil. I just got squeezed too fast and too hard. I got taken out here, and then that happened. So I took a 4% loss there, whereas I could have made a 4% gain if I wanted to, probably, but I didn't. But that's the downfall to this style of trading. You will get to a point where you are too uncomfortable and you need to do something about it. And for me, with oil, because I've been squeezed and had aggressive positions I've lost money on, I got out. at the wrong time. I made that decision. I know some people in here didn't make that decision to get out. They held it and they made a nice amount of money. Well done you. I will make loads of money on some positions that you won't. But that doesn't matter, does it? What's important is we all ride the waves. It doesn't matter when you get in, when I get in. If I look, people put charts in there. I think it was New Zealand dollar yen we looked at yesterday, wasn't it? As an opportunity to go long, which is a beautiful long, yeah? This is somebody called this here yesterday. I think it was someone. Who was it? Called it? Simon. Probably in here now. Called this long yesterday. Didn't put a chart up, so I put a chart analysis up of this yesterday. Beautiful. Absolute textbook entry. Exactly where I want to get in. Amazing. I'll show you on here because it's really good sell. Yeah, this is the setup. This is absolute textbook. This is what I dream of. Lovely push down to the 24, bullish engulfing there. Reverse alert, W pattern, retest off. Extended RSI, just perfect. Exactly what I've been looking for. I've been saying, haven't I, for weeks. I'm waiting for a pullback to the 24 on a yen pair to get in. What happens? We get the pullback on the yen pair. I'm exposed. I can't take it. That's me. Someone else is now sitting in New Zealand dollar yen. I'm not. We're going to have completely different portfolios, but just follow the rules. That's all you got to do. Yeah, I couldn't take it because I'm long New Zealand twice. But that is a lovely setup. But anyway, stop talking. Asking questions. 2 p.m. 2 days ago, 1 hour spike clears the tops. On some brokers it happens, others it happens very large. On some brokers it's just not there. There's nothing you can do about it, Sammy. Stop looking at other brokers is the answer to that. Look at your broker and trade your broker. Yeah, look at that Swiss yen trade I took and look at where I got stopped out on it. That's where price ended. That's where the spread took me to. Other brokers will give you a spread like that, and that will be the high. Other brokers may not have got that high. It may have gone to there. They may have been spread that far. I have no idea. It doesn't matter. What is that? What happened after that? Just a liquidity run. How high it was, there's no relevance whatsoever. It happened. The banks took every short under the sun. They double end stop hunted it. And then they moved the market down because that's where they made their money. What they're going to do next, I've no idea. But it doesn't matter where it got to. And that's the thing you've got to get out of your head. And this is the problem with support and resistance. Everybody goes, that's resistance. It's not. Somewhere around there, there's a load of money. I don't know whether the stops are there, or there. Neither does the bank. So what will the bank do? It will push price up until it goes, we want to buy, we want to buy, we want to buy, we want to buy. Oh, there's no one left up here to buy. There's no more sales up here. All right, okay, well, let's move back down again then. How far that is going to travel has got nothing to do with anything apart from how many people are sitting there with liquidity the banks can use to make a move in the opposite direction. There is no way of telling whether your broker will make $1,000 there or $1,000 there. Your broker, when the price moves up there, will widen the spread to make as much money as they possibly can. They will take it 2 to 3 pips higher than everybody else if they need to make that extra K. If that extra K isn't there, they won't bother. Your broker can see every single order in the market, and your broker will widen the spread as much as they need to make as much money as they want to at that particular point in time. This is why you will get a different price from one broker to another. Nothing more complicated than that. Money grabbing. Why do you think the banking sector and bankers are the richest people in the world? If you could go back 200 years, what would you do as a job? I would set up a bank, Samson Bank it would be called. And everybody that's ever been any of my descendants will be multimillionaires now. Because somebody somewhere identified a way to extract money out of everybody in the country. Get on them. Wasn't us. But anyway, right. So there's all the questions done. That was good. Good tranche of questions this morning. Anyway, these are all my opinions, obviously. You know, if you disagree with them, disagree with them. It's not a problem. At the end of the day, as long as you can make money out of something in the market, that's it. Your job is to extract money out of the market in any shape or form you can. Using any instrument you can. These are just the ones I've found that work for me. Right, so ADRs we've looked at, Aussie dollar Swiss. Aussie dollar, I'm going to whiz through these. These are the weekly ranges. Yeah, everything's already hit and everything's already bounced. So pretty much all of these, you've missed them. They've happened, unfortunately. We're on Thursday now. Aussie dollar, US dollar. A lot of these US dollars obviously have been caused by the interest rates numbers. Euro Swiss, massive short. It's not extended. We have had that move down this week. So it's kind of still in play a little, I think. So the high is, can't see it. High is there. We haven't gone anywhere yet. So we've hit the weekly range down here. We've got that reversal alert in. We're not really making any progress. So this euro is just not strong, not weak at the moment. We were kind of relying on the Swissy powering up a little bit, ready to pull this one back down again, or weaken so that the euro's got some strength. But at the moment, it's not gone anywhere. So when we get this situation, think about what we're just talking about with these three pushes. There's two. Quite possibly going to get another one, aren't we? Yeah. So this could well extend this week. We've got lots of options expiries coming up, so there's potential for a lot of volatility tomorrow. But, Euro US dollar, again, this is caused by the interest rate figures. One of two things is going to happen. We're either going to get these orphaned. Why is that not drawn? I need to switch timeframes. That's not drawn properly. We're either going to get this orphaned propulsion gap, or we're going to retest it, and then the sellers, you know, the banks have gone short here. They're going to add here if we get a move back into that. Quite often with a fundamental shift like that, you don't get that. You just get that. So I get the feeling we might get an orphaned propulsion gap here. We are tapping into an area where we previously started that move. So there's going to be buyers here, you know, and this is the banks fighting it out for, you know, for the money basically. So it could go either way. We are finding support down here though, you know, and I say about it doesn't go to the pip. It does sometimes, but this is what everybody's looking for, and that's not what you're going to get the vast majority of the time, is it? You're not going to get that to the pip. That one's a beautiful one. To the pip. What do you think everybody's done here? How much money do you think is sitting under there right now? Everybody long in the euro US dollar. Every mean reversion trader in the world is going, yeah. Every breakout trader in the world is waiting for that Asian high to get snapped. Every breakout trader in the world that isn't taking short term is waiting for that breakout to get tapped. Where are they going to put their liquidity? Under there. Does the market want it now? Or does the market want it later? Or are we just going to go because the banks have gone, no way on God's earth, I'm long in this, I'm short? I don't know, don't care. Make up your mind. No one can answer that question for you because nobody knows. Everyone can give you an opinion. No one can tell you where it's going. New Zealand dollar Swiss, and just ignore everybody. Ignore me. You know, take your own trades. Yeah. With the way that I teach, what I do, it's not about my analysis, as you know. And I've had many jokes, and I will continue to get many jokes in the Telegram group. Wait for Lee to take his 5th position, then get in. Yeah, you're right. Wait for me to get in for 3 or 4 positions, then get in, because I'm always early. But that's just me. So, you know, ignore my analysis and do your own thing, but don't follow my analysis, follow the methodology. The methodology is taking a position, scaling in at logical areas or at an ADR distance that makes sense, and then scaling out. You don't need me to execute the methodology. The methodology works on everything. Whether you get into the same positions as me or not is, it doesn't matter. Get into whatever you want. New Zealand dollar Swiss. Sorry, howdy. Again, big old move down in one candle there. Swiss franc. We are starting to move now. Lovely accumulation. And again, breakout traders all gone long there. Yeah, the move started. Break even. Stopped out. Oh, I missed it. What happens when you break out trade? Because you're scared. Because normally you break out trading against the trend virtually all the time. I don't know why we do it, but anyway, we do. So yeah, New Zealand dollar Swiss, you've missed it. It's already happened, basically. New Zealand dollar yen, missed it. It's already happened. New Zealand dollar, US dollar, that's kind of stuck. We haven't gone anywhere. All the US dollars basically are still being held down. There's still a lot of weight on the US. And US dollar CAD, same thing. I'm long on that one up there. But again, I'm long on that there. I get the feeling on this move, today, because we've got so much volatility potentially expected, we could just get a push. And if that happens, I'll be out up there. I've taken one trade on this and it played out straight away. I'll take this one. If this one gets into sort of 0.5%, I'll take it and then I'll be out. And then I'll wait and see what happens. If this doesn't work, I'm pretty sure we're going to get that sort of movement. So that's fine. But yeah, you've missed most of those, unfortunately. RSI dashboard is flat, totally flat at the moment, because a lot of these moves have stalled or have played out. So anything that's pushed really hard and pulled back, obviously you'll get RSI returning to the mean. Anything that has pushed and stalled, you'll get RSI lagging. And then potentially moving up again and extended again. So there's nothing to look at on the RSIs, but all these moves that we've got on the US dollar, I think are probably precursors to strength, but we have to be very careful because next week we've got FOMC. So everything that's happened this week is good news for the dollar right now, which you can see has inflated the dollar. What the Fed does next Wednesday is going to affect what happens to the dollar over the next month. So if the Fed comes out at 3.5 or so, it's going to be a completely different result to if they come out at 3.25. So we need to wait and see what happens to the Fed. And again, at the moment, we've got all these figures coming out, and literally every week there's something important happening. Next Thursday, basically the whole thing, next Wednesday through to Friday next week is just solid news and fundamental news and stuff that is affecting the markets, or at least one currency in a massive way. So we've got to be very, very, very careful next week. But this could all change. Yeah, next week the Fed could come out and basically say, "Oh, we're going to go at 3.15 because we didn't want to go quite as high." The US dollar is going to go through the roof. They come up at 3.75. The US dollar is going to collapse. You just don't know, do you? We've got no way of telling. If it comes out at 3.25, that's what I'm most worried about because I haven't got a clue. Because when you get an as expected result, the market has typically factored that in. So if the market has factored that in, interest rates have risen and the market holds it and pushes, I would say an as expected result would be positive for the US. But you can never tell. If you get into a point where there's a load of liquidity sitting, you might find you get a pullback first. Again, these are things that we don't know. But what we do know is, at the moment, you want to be buying the US dollar CAD. based on the current fundamentals that we have right now and what is anticipated. Yeah. And that's why these moving averages are so important to me anyway. Yeah. Crosses are, these crosses are irrelevant. And anybody that's in here that's fairly new and has looked at moving average crossover, and this is the other thing. I don't have anything against Steve Maurer. I think he's done a lot for the trading community and he's identified a lot of really good stuff, but just I don't think in a way that helps most people. But moving average crossovers, he was a real, I think it was the 20, 50 and 100, was it, or something? He used to have names for them. I think there were sauces or something, weren't they? Ketchup, mayo, and something else. I can't quite remember. It was a long time ago. But the moving average cross will always happen way after the move. Yeah, look at that. As the crossover comes in, the market's actually coming down the other way. The moving averages crossed there. You missed all of that. Why? Because you didn't take that. This is why. This is like I say in the course. When you're doing any course by anybody, me included, it's just me and what I've worked out and what works for my brain. Your brain is different to me. Some people have got the same brain as me and wired the same as me. Some people haven't. My brain looked at everything that he did, Steve Maurer, and other people out there did, and I could just see where there was things that were wrong in it. It's just my logic. I've got a logical brain. I'm a programmer. Me. I could see this was the TDI for him, I think. It was TDI, wasn't it? The only bit of the TDI I could see that was important was the shark fin, because the shark fin, I think, was what signaled an entry. So I was like, well, why do I need all this other crap? There was Bollinger Bands on there. There was multiple moving averages on there. At the end of the day, all the TDI is an RSI with a load of crap over the top. So I thought, well, yes, yeah, mustard. That was the other one. Thanks, Andy. Mustard, ketchup, blueberry. Yeah. Unless you're colourblind, in which case then it's all out the window. But that's the bit I found, the RSI. And I looked at that TDI indicator and it's like, well, why is all this other crap on there if all he ever talks about is a shark fin? Get all that off there and look for these shark fins. And these shark fins worked better down here than the shark fins here. So I was like, well, I developed a shark fin indicator because the one with the TDI, I thought the professional TDI, whatever it was, didn't work very well. So I developed my own shark fin indicator. And I'd back tested it, and every shark fin that happened above the 30, below the 30 and above the 70, worked better. Got to be a higher strike rate. And that's kind of where my entire strategy started from, was like, well, this thing, when I back test it, it seems to be every time we get down here, at some point soon it goes. But not all the time. So I was like, well, why should I take all these losses when I could split my trade up into smaller parts and just wait? Because it always happens. It's just sometimes it takes longer than others. And that was how position trading was born. And then I took everything I knew from everybody else I'd ever learned and put it all together. And that's what I say, watch the bootcamp. And if you don't want to trade the way that I trade, that's fine. The methodology is the same. Don't let the market take your stops, because it doesn't need to. And this is why this is at the core of everything I do. That when this gets there, that's going to happen, because to get that there, the market has to have had a push. And the market pushing is the banks loading up their positions, ready for a profit take. So this is literally telling me the banks are loaded. Banks have loaded. The banks have loaded. The banks have loaded. The banks have loaded. What do I need to do when the banks are loaded? Jump on their profit take. How much profit take is it going to be? I don't know. So I'm going to get out fairly fast because I have no idea. But I know the banks are loaded there and there. And that was taught to me by somebody completely different, how the banks work, by somebody that used to work in Barclays on the dealing desk. And he also worked on the market making desk for a short period of time. He explained to me how the banks work and how they pass the book from session to Asia, to New York, to London, and they keep this 24-hour thing rolling by passing their books across to make money. explained to me how they accumulated orders. And I was like, hang on, someone else used to talk about that, accumulation distribution, supply and demand. So that was all confirmed to me by somebody completely different. Steve Malrell told me about this thing. I identified that this and that, the banks and the RSI have a confluence. When the RSI gets extended, I'm thinking in the back of my mind, a guy from Barclays told me that this is more likely them making that move after they've built their book. And what did he tell me happens after they make their move? They profit take it. And that's why this is my core, because this tells me when the bank, this tells me what the banks are up to. I couldn't give a monkey's what's happened back there, really. But what's happening right now, the condition the market is in right now with the banks is X. That's what I'm interested in, because I am anticipating the Y. And this is where everybody goes wrong. And I went wrong in trading for many, many years. I was trying to find the indicator that would predict the Y. Every indicator lags. So how can it possibly predict? Can't. It's not possible. There is no indicator in the world that can predict. There was an EA I saw on AMT4 Marketplace the other day, and it said it was an advanced AI or a machine learning algorithm that can predict price movement. And I had to reread it, and I was like, I know how MT4 works. I code in it. There's no such thing as machine learning. You can't code machine learning into MQL5, I don't think. I might be wrong, but basically it's just a load of bollocks, basically. Nothing can predict where the market's going to go, because I don't know whether the Ukraine is going to get invaded by China next week, because Putin's having a chat with China. I don't know whether China's going to come and invade Ukraine with him next week. I don't know. Do you think that machine learning algorithm is going to know either? No, I don't. The banks don't know either. But I know what the banks are going to do. And, this is the thing. Forget indicators. They have a use. They give you some clues, but you've got to know what's going on under the hood. It's like being a mechanic. Anyone can get in a car and drive it. When you break down on the motorway, unless you're a mechanic, you can't fix that. You've got to be a mechanic in the markets. I like my car analogies, don't I? Do you still have the sharp fin indicator? No, I don't. I built that in the days when, actually what it was I found the code for the TDI. There was two versions of the TDI out. There was the TDI, which was by, what was his name? The guy that made the TDI. But there was a TDI, and then there was a TDI Pro. And the TDI Pro had coded into it an alert system, whereas the TDI didn't. I found the raw code for the TDI somewhere, and all I did was I uncoded everything but the RSI section of it from the TDI, because it was done, and I just basically stuck an alert system on it, and all the alert system was, it's probably pretty easy to code, but all the alert system was within X number of candles, we need to have a break below and a break above. Because a shark fin isn't that. That's not a shark fin. A shark fin is a sharp, fast move. The reason, and what happened, this is probably going to bore you to death, but I'll make it very swift. This indicator that I created, this shark fin alert indicator, turned into the market reversal alert indicator. And the reason behind me building this was because the shark fin indicator was great, but what I wanted to do was only see shark fins when we'd had a breakout. Yeah? So what I wanted was a shark fin, but don't give me that shark fin unless price has done something like that. A breakout. Market structure has shifted. So I moved away from this indicator, and I developed the market reversal alerts indicator. And that's how my initial strategy with stop losses started, was when I got this indicator built, I was looking for RSI extensions, because when this condition happens, that happens on the RSI. So if you've had a push, yeah, and then a pull on the RSI, you have a shark fin. those reversal alerts, that alert there will do that. So by having this extended and that happening, that's basically what I was looking for. So I scrapped this, and it's a period where I wasn't keeping indicators. And you know, with MT4, your PCs break, you lose your indicators. You've installed MT4, you forgot to save that. I just lost it over the years. It'd be pretty easy to make one. All a sharp fin indicator is open below, close above, open above, close below within X candles. And that X candles you can fine tune to get more of that type of shark fin, or that type of shark fin, or that type of shark fin. It's the X candles which will make that signal be different. And again, I found it's the same with all indicators. The more variables you have, the more you can fine tune it to work every time. But fine tuning something to work every time in the past has got nothing to do with the future. So that's where it all came from. Anyway, so there you go. There's my life story of building shit. You could code it in any language using a DLL and hook that into MT4 EA indicator. Yeah, so talking about machine learning, yes, there's all sorts of ways of hooking into EAs and indicators. I know for a fact that this particular MT4 EA that I was talking about that said it was about machine learning was a load of rubbish, because, and this is a really handy thing for you whenever if you're thinking of buying an EA, you know, they put these monitoring URLs up. So they'll create a signal for the EA. Yeah. The vast majority of those will be somewhere between 4 to 12 to 18 weeks old. Yeah. And then the EA will go wrong and it will start losing money, because when you curve fit an EA, it will have a period where the recent price action continues, the recent market conditions continue, and that EA works. Then market conditions will change. So, for example, I built a trend-based EA. Every time the market's trending, it makes money. Every time the market's range-bound, it loses money. So I put it on a signal. Market's trending. It makes a load of money. Everybody buys my EA. Then all of a sudden, market goes range-bound, and my EA loses loads and loads and loads and loads of money. And everyone goes, oh, this is crap, this is crap, this is crap. So I cancel the signal, and then I put a new signal up for the EA, hoping that we're going to go into a downtrend. Then it starts making money. So if you see any EA monitoring that is less than a year old, the EA doesn't work. That's just the way it is. Anyone can have a lucky streak with an EA, but at the end of the day, that EA is going to blow your account because it cannot adapt to market conditions. You can. I can. My market reversal alerts EA has been running for over a year on H1M5 with that signal, and it's still there. It's still trading. It's still making money. I don't know. It's making money now. It's sitting there making money. It's running on. This is it. This is the actual thing. God, this dashboard. This is running in 4K mode. I can't figure out how to switch this off of 4K mode. But it's running at the moment in 5% drawdown. It's made, well, this week it's had a bad week. Not made much this week. But it's been running for a year on that VPS. And it's still going. Yes, it's had 40% drawdown. But of course it's had the Ukraine war kicked in. Nothing's going to survive the Ukraine war. Mine, EA did, but yeah, it blew half, well, it didn't blow anything. It drew down half your account. But it's made over 100% return on investment in the last 12 months. But no one's going to buy my EA to do that because no one's interested in 4 to 5% return a month. Everybody's interested in 20 to 30 because you can't buy a Lambo at 5% a month, can you? And that's what everybody wants. Unfortunately, I haven't got. There's a lot of those appearing at the moment. My Facebook feed's getting pumped with so many people in swimming pools, in beautiful resorts with Lamborghinis and big garages of cars. The guy's 18 years old. This is Dad's house. His dad's a banker. He hasn't got a bloody clue what he's doing. But he can stand in front of his dad's house and drive his Ferrari around for the day. That's what they do. There's one guy I know for a fact, he got caught. He rented a Lamborghini. You know how we knew? It had the hire company's logo on the number plate. That's how we knew it was rented. The guy got caught. Driving around in his Gallardo, hired from Hertz. Anyway. Anyway, I digress. So, let's have a quick look at the indices before I disappear, because we need to look at those. I haven't looked at those yet. The whole plan in Ukraine is maybe calculated with advanced AI using quantum computing to process it. Not only one, but a cloud of quantum computers. Yes, that is true. Who knows? Just hope those quantum computers with that advanced AI do not get in hold of the nuclear button, because that's how Terminator started. Machines take control. We become a pest, they blow us all up. Or they release some virus. Hang on a minute. Anyway. So there is no MQL4 EA that will make me a Lambo and 400 square meter house on the beach. No, not that I'm aware of. There's a few high risk ones that come close. I mean, there's one out there which has been running for 230 odd weeks, and it's got over a 2,000% return or 3,000% return. Northeast Way, you might know of it. But Northeast Way is incredibly high risk. And do you know what it does? It position trades with drawdown control. Funny that, isn't it? The only EA that has actually stood the test of time on MQL5 Marketplace is trading my strategy. Not by me. He came up with his own. He's a Russian guy. But it's incredibly, incredibly high risk, and it has taken massive hits on the account. The account has drawn down by 30 to 40% on a number of occasions. And the problem with that is if you decide to start using that EA 2 weeks before that 30% drawdown comes, you will immediately lose 30% of your account. You'll never get that back without over leveraging. So you've got to catch it at the right time. Like with anything. Got to shoot, Andy. Yeah, catch you later. So yeah, there's a few EAs out there, and the guys that run those EAs are trying to replicate themselves. And you know, my EA replicates the way that I trade, but I can't leave it running full automation without going into big drawdown, because drawdown control is impossible to execute, because you have to use multiple instruments to do it. I will rob Peter to pay Paul, as such. Yeah, if I get a massive win, let's say the DAX today collapses and goes 200 ADR, and I make 1,200 off of this trade, I'm going to use that 1,200 to offset that and half of that, and maybe a bit of that as well, to get on top of that. The EA, the Market Reverse Alerts EA, is not intelligent enough to do this. There is possibly a way that I could code it in, but it's infinitely complex, and the amount of variables in it would mean the thing would be even more slow and complicated than it is at the moment. So I'm not interested in going down that route. But that's the bit you can't replicate, the drawdown control. So I can use this 1.1 today to basically remove that position, which will drop that down dramatically. Happy days. But do I want to make that decision? Can an EA make that decision? The EA needs to take into account whether I'm happy personally with this. And I am happy with it this month. Why? Because I've made 30% last month. If I hadn't made 30% last month, I wouldn't be happy to do this drawdown control now. The EA can't make that decision for me. Only I can make that decision. And that's kind of what that EA on the marketplace is kind of attempting to do. And I think you could probably squeeze a lot more out of it. But when you look at the return over the period of time, it's still not Lambo money. Still nowhere near Lambo money. And to get your Lambo, if it was Lambo money, you'd have to sit through 35 to 40% drawdown on your account. Are you happy to sit through that? and then to recoup that is going to take twice as long because it runs on percentage risk, as I do. So I'm risking 0.25% on a ADR stop on every position that I take. So if my balance drops by 35%, my lot sizing drops by 35%, something like that, or 18 or something, I guess. So now to make that 35% back is twice as hard because I'm taking smaller positions and making less money. And this is the people that do compounding, they don't understand. And compounding EAs never, ever work because a compounding EA will increase your lot size and in the back test, it'll give you that equity curve. Right? When it gets a losing streak and it's trading 50 lots, that losing streak happens like that. And that's why you can't compound. It doesn't work. On paper, it works. I've got an Excel spreadsheet that does compounding. On paper, it looks amazing. I even told my wife at one point, this time next year, we're going to be millionaires. Look, all I've got to do is find a 50% strike rate system that has a 2-to-1 risk-reward ratio, and it cannot fail. It's going to make me £2 million. If I put in now 10,000, we'll have 2 billion in a year. It says so on the spreadsheet. Try executing that. It's actually possible. Because the first 10 trades I took were losers. So instead of taking $100 risk per trade, on trade 11, I'm only taking $50 risk. How am I going to get that back? All that loss, those 10 trades lost. How am I going to get it back by risking half as much money? Doesn't work. Compounding, just a myth. Increasing your position size and lot size when your account balance grows, fine, but you can't compound it exactly because you're going to want to withdraw money. Yeah. If I had that strategy and that compounding and it worked and I got up to 250 grand in the bank, I'm going to pay my mortgage off. I'm back to square one. Anyway, talking a lot of rubbish today, aren't we? But it's good rubbish. It's good rubbish. It's all education. It's all stuff I've been through. And, you know, if I could save somebody 10 years or 2 years off of their trading journey by learning stuff that I just know doesn't work, you know, what are you doing? The euro strength showing at the moment. Hopefully this is just a profit take move. Keep an eye on this one today. Just realised I haven't got a stop on that aggressive position and it's quite a long way away. A bit bigger than I wanted on that. I'm not paying attention, that's why. I'm just going to, this aggressive position here, I'm just going to take a $100 loss on it if we push any higher today. I don't want, we've got an accumulation break here, this propulsion gap, which has already been tested once. We've got some very nice wicks showing at the moment on the 5-minute chart. So this may be a little bit of a pullback. Just going to move that up a little bit. I'll take 125 risk on it just because the spread's so big. But if this is going to come and retest these highs, I don't really want to be sitting in that as drawdown. I'll take a little bit off. And I can always add that back on again. Oh my God, I wish I had known all this 10 years ago. It would have saved me so much grief. Yeah. That's why I did it. That's why I did the videos. You know, it's my entire knowledge base of what works and what doesn't. But that's just me. You know, like I say, it's just me. It's what works and doesn't work for me. Everybody's different. You got people that are scalping in one and making a fortune. I can't do it. I don't know anyone that can. I know there's people out there. There's a few of them. I would probably count them on one hand in the world. But there's a few that are making enough money out of it to make a living. But I'm not geared to work that way. Right, indices. I just want to cover the indices quickly. So Next leg down has started on DAX. Obviously, the interest rates, the inflation numbers drove the market back down again, starting from here. So we got a nice pullback to the 72, and we kicked that next move down, which is lovely. So I'm expecting that to continue as long as we're getting positive figures coming out of US and we don't get anything massively negative coming out of the US. We should see a continuation in strength, or at least no massive weakening, I don't think, on the US dollar. So if we get some decent numbers on retail, or retail comes out as expected, I think we'll probably see a little bit more continuation on that, which means the indices can carry on their current move to the downside. So obviously next leg is we're looking for new lows basically to be made. This one, we didn't make a new low. So we are contracting. Yeah, so the expected direction obviously is an explosion down because we're not doing well. If the Fed can get on top of inflation much faster, then brilliant. But this move that we're seeing is since December. So, you've got to take this into context. We're now in September. Yeah. The Fed can sort this out in 3 to 6 months, in which case we could see an accumulation build. But the likelihood is we're going to go into recession. So we should see more downside movement. So still looking for shorts. Obviously, where we are now, we've had this big push down. There is an argument for a pullback on that move, but the market may not necessarily need it. So we will have to just wait and see what happens and plan. Same thing here. Obviously, the US indices got hit way bigger with that move. We are just flagging. So think typical flag will be something like that. It will break. And again, everybody will try their very, very hardest to draw that perfect flag on with their little trend lines. So at the moment, the flag looks like this. Yeah. Something like that. Yeah. So everybody's looking at this thinking, when we break this level here, I'm going to go short. Other people will be looking at it going, when it breaks this level here, I'm going to go short. Other people will be not thinking that at all. They'll be thinking if we break out to the upside, we're going to come and retest this and come back down again from ADR. Everybody's going to have a different opinion on it. I don't know which way it's going to go. But a typical flag move like that is something like that. When we start to move down, when we break that low, that's when I'm really, really interested. But look at it on a higher time frame, on the daily. We're obviously in a massive downtrend, so we're looking for short opportunities. As I said yesterday, and exactly what I said yesterday as one of the scenarios happened, we got that pause bar. Yeah. So I said, we're going to get that followed by that, or we're going to get that followed by that. That's what happens after an extreme move like that. Quite often, we will get on a big move of 50% pullback. So there is potential for a flag to be multi-day there. This is long-term stuff. But quite often what happens after that is we get volatility and a drop. But sometimes we get that. We just don't know, do we, at the end of the day? But this is the middle of the next leg. So we would expect a downward move. But I get the feeling we may well have that pullback starting. So I don't know. You have to let the market decide and the market tell you which way to go. If you're scalping, that's, you just pay attention to what's happening now. Right now, we've got bearish engulfing. You want to be shorting it. We don't want to be doing anything until New York, really. But so I get the feeling we're probably going to want to ever so gradually pull back. So if you're scalping it at the moment, I'd be kind of interested in short-term longs. I don't really want to scalp it this morning. I'm going to wait until New York. But yeah, so shorts all round. But whether or not we're coming here first or not, I don't know. 1:30 this afternoon, depending on the figures, that decision could be automatically made for us. So if we get strong figures on retail, we're just going to break this level and we're going to go, yeah, the market's not going to be able to sustain a pullback. There's not enough buyers in the market. You can see there's not enough buyers in the market at the moment. So the banks are not interested in buying it here because they're short. So you're really reliant on some large retail, large investment banks, say large, not the major banks, but the bigger hedge funds, the bigger investment firms. You're reliant on them entering longs to drag this up. I don't think the banks are going to do it. And if that news comes out, obviously we're going to get that shift. So be very careful with it. I'm in DAX short at the moment. As I say, I've got one position on down here. Not really worried about that. I've got one on here. I've got one a little bit close, which I'm a little bit concerned about. Yeah, pull up to there. I'll be spreading out my positions half an ADR at least before I get into another one, and then looking for that. But I want this done by Wednesday next week, regardless. So I don't want to be sitting up here in drawdown when FOMC comes out, because the Fed have got the power to do what the hell they like with this, haven't they? So looking good for shorts, but at the moment it's a mixed bag. Very difficult to tell which way we're going to go. It's the EA's just got me into that, isn't it? Yeah. So that position that I just stopped out on, the EA's just got me back into it. That was that one I stopped. I closed that out. Obviously, we just had a reversal alert. So EA's got me back in. Which is fine if we drop, but if we don't, I don't want to be in it. This is a manual position I've taken. I should have closed my manual out really, but I couldn't. I'm just going to put it's only a $50, tiny little stop on it. I just don't want to go into drawdown on two positions quite so close together. So if we do get up to here, I'm happy to take another reversal alert up there because the spacing will be better. 147 is half an ADR. That's 148 up here, around there. So I'll take a little, this is only a tiny little $50 loss on this position if we push. If we drop, I'm happy to hold it, obviously. But I don't want to take a big risk on this, just in case. And the only reason I'm just in casing this is because of the ferocity of that move. You don't know how big that pullback's going to be. Unlikely they'd retest the highs, but we've got a big old move there, potentially. So I don't want to be too aggressive with it. Okay, so that's really all I've got for you today. It's quite a good session. Lots of educational stuff in there today. It's always good to have one of those every now and again. Obviously, this will be on YouTube, so you can always bookmark it if you want to come back and watch it at a later stage. About lots of stuff, but it's good. Keep asking questions. Bringing up subjects, asking opinions. It's how you learn. How I learned. I questioned everything, and I disagreed with most of it. But if you don't ask the questions, you never get the answers. Right, I'll be in the Telegram group today if you need anything. Worrying about your own New Zealand. No, I'm not. Well, I still am, but nice W there. Again, this is all Steve Marrow. I talk about Steve Marrow. The M pattern and the W pattern. He didn't invent those, obviously. He didn't invent market structure. Neither did anybody. It's just what happens in the market. But I use the terminology M pattern and W pattern. I don't know who invented it. It's not copyrighted or anything, but that's what the reversal alert indicator is doing, is telling you when you get. That's why I built it. So, but yeah, you see them everywhere after a while. You just see them. And everybody's looking for that perfect one. That's not perfect in any way, shape, or form, but that is definitely a push, a pullback, a lower push, a pullback. It's a uneven M as opposed to a stop hunt M. It's all just market structure. Anywho, I'll shut up now. Have a good one. I'll let you know if I close out anything in the Telegram group. You can see what positions I've got on. Euro New Zealand, I'm still on one aggressive at entry at the minute. That allows me to bring my stop down now, because if we come back up and retest that, I'm definitely not interested in being in it. So with that spread, it's double top, isn't it? I can't. If I get taken out by a double top, I'll cry. They'll probably widen the spread and take me anyway, but that's the other thing. You'll never see this happen on a demo account. On a demo account, if they go up to there with an exact double of top, I'd still be in the trade. On my account, they'll widen the spread, because that's real. They don't stop you out on demos. Everybody, and you can attest to this yourself, I'm sure. Everything works better on a demo account. Wonder why. Anyway, I'll leave you with that. Right, have a good one. I'll be back tomorrow morning, 7:50, same time. If you need anything, come in the Telegram group. Be in there all day. 1:30 this afternoon, we've got news. So be aware of all the core retail sales, an hour before the market open. And then we can go from there. And we'll have a look at tomorrow, what's happened on retail. And yeah, get ready for next week. All right, so have a good one. I will see you tomorrow morning, and hopefully it's profitable.